All right. So our Alaskan non-winter continues again. It's the strangest winter I've ever seen, but it won't interfere too much with classes. Class, we're going to talk tonight about taxes. Taxes are kind of interesting because it definitely affects how you plan things out. Unfortunately, in a perfect world, whatever. Like I say, I've lived in different places, and different nations get their income from different sources. And believe me, I lived in in Germany and other places in Middle East and stuff. But anyway, at least places that were under in the EU, in the European Union, they charged super high taxes, but they were not as painful because they just had a value added tax that was just like kind of a huge sales tax, and you didn't waste as much time on doing your taxes, nor was there an entire industry. I mean, it's like everything we do now. We've got, big pharma, we've got big tax, we've got big whatever. Well, I'm going to talk about one of the, kind of the Raytheon of big tax, which is Intuit. And so if you hate why the tax code is complex as it is, well, it's not by accident. There's many people, lawyers, software writers, and the government themselves that are all kind of in on the game. I mean, the IRS knows full well that the last thing people want to do is get in trouble with the IRS, so they tend to overpay. And so people tend to overpay a lot on their taxes. And it's sad because it's so complex. There was an old, this is going back some years, it was Weinberger. I think it was Weinberger. Anyways, Secretary of Defense. And he was just a, super opinionated kind of guy. Had whatever, always expressed himself on anything he felt, which, whatever, I guess we all do that to a certain extent, sorry. But anyway, what he said was he would always include a letter to the IRS saying, I have filled out these taxes to the best of my ability, but I can't, guarantee they're accurate. Because when you do sign their 1040 return, your actual tax return, you verify that it's all in accordance with the laws, and you can't. They're conflicting. There's so many gray areas. It is a mess. Okay, so enough of the negativity. The other part on taxes is from a financial standpoint, what you need to make sure is that you keep as much money as you can. If you're fortunate enough to earn money or gain money through investments or whatever, you've worked very hard for that. And the last thing you want to have happen to it is it be taken from you needlessly, because there's ways to avoid taxes. And if we all had the wealth to have our entire team of lawyers, we would probably end up paying a lot less tax. But since we don't, we need to figure this out on our own, or have somebody help us with it. But anyway, so the good thing about taxes is, they're an integral part of the economy. Obviously, it does fund things. Paid on earned income, purchases, so sales tax, wealth transfers, and capital assets. So the death tax, the wealth transfer tax, not quite as high. Theoretically, if you give your kids, over $15,000 a year, something like that, that's above the IRS limits. You'd have to report that. They'd have to report it as income. But anyway, and then capital assets. If you make some money on something, like you buy a stock for $20 or Bitcoin for, 700, and you sell it for 100,000, yeah, the IRS wants their cut. And basically, if you've had it over a year, and again, remember from previous definitions, over a year means long term in IRS or personal finance terms, and it's normally subject to a 15% tax rate. Now again, new president, and should be optimistic for taxes, in terms of lower and other things. There's a famous guy, kind of controversial. You can look it up if you like. He was back during the Reagan years, so Reagan himself was obviously kind of controversial. But a man named Art Laffer, and a thing called the Laffer curve, and it's pretty interesting. What he talked about was that he wasn't trying to shortchange the government by any sense, and even that terminology. I mean, it's not the government's money; it's your money. But he wasn't trying to achieve less in terms of revenue for the government. He was just pointing out the more than obvious fact that there is a certain tax rate amount, that you can take from earners that is going to extract the maximum amount of wealth. For example, if you say the income tax is 5%, that's pretty low. And so even though growth would be outrageously large, 5% is not quite enough, and that's not going to probably do it. Conversely, you'll see politicians say, oh, we're going to tax the billionaires at 90%. Well, that's too high. The billionaires won't pay 90%. Billionaires are mobile. Billionaires can move. Billionaires can hire lawyers. The thing is, anytime any of these politicians propose these taxes with outrageously high numbers, they don't collect it. Sounds good in the election, but in retrospect, they get nothing, much less than they would have had. Now, there is a certain point, let's say 25, 20, 30%, whatever that number is, it's on a curve that can be calculated, that is the number where you can collect the maximum amount. If the number's too low, you're just not taking enough of a percentage. If the number's too high, you're slowing down people. People are going to spend more time not paying their taxes than they are making money. What you want is companies to be so profitable where the tax rate, say it's 15%, it's just irrelevant, where it's not a big deal. We'll just keep making more and more money because we don't care. We'll pay the whole 15% and we'll just not worry about it. Whereas if it gets to be, say, 35%, they're like, we're going to cut back production. Maybe we're going to move production offshore. We're going to do whatever. We may just cut back on production. Or in the case of like these billionaire taxes, a billionaire's not going to go out there and work. First off, that person with that kind of wealth doesn't need to work very hard anyway. But if they're not incentivized, if they're working and they only get to keep 10% of their wealth, they're not going to work at all. And they're going to take their wealth and go someplace else. And you think, well, fair enough, that rich guy can leave. Well, guess what? That rich guy owns factories. That rich guy invests. Rich people, they got rich by investing their money. They didn't sit on their money to get that. It wasn't sitting in a bank somewhere. It was actually out there buying things. When that rich guy owns a big yacht, somebody's paying for that. Somebody's out there working on that yacht. Somebody built that yacht. Some factory. I mean, anyway, we could talk about how this works, but I'm a proponent of the trickle down theory, and I think most people would if they study through it. So anyway, the Laffer curve, if you want to talk about that concept. Other taxes, so earned income, purchases, wealth, capital assets, and then special taxes, sin taxes. This is kind of a slippery slope because you get people dependent upon it. The cigarettes, not that many people smoke as much anymore, and there's all these programs that were put in place, childhood education that were funded by cigarette taxes. Well, when people quit smoking or that tax amount goes down, those programs stay, and programs that might not have been popular in terms of general funding, but it's just going to come from cigarette tax, don't worry about it. Well, now all of a sudden the cigarette tax is gone, and those programs exist. Alcohol tax, there's already a slight one on that, but I don't know if you noticed lately, there's a talk about alcohol causing cancer. Again, people have been drinking for literally eons, and if there's a spike in recent cancer rates, it might be attributable to something else. Anyway, you can pick whatever your conspiracy on what's driving the cancer rate, but to say it's alcohol when alcohol consumption is actually had leveled off and was already going down. But anyway, if you can say it causes cancer, then bada bing. You put a new sticker on that bottle and charge a higher tax, and get more revenue. So anyway, and then gasoline. Gasoline sometimes could actually be fair in terms of, the more gasoline you buy, theoretically, the more miles you're driving, and therefore, it goes to road and transportation. Good, but as cars get more efficient, or if people go electric, the gas taxes go down to the point with, if it's all electric cars, who's paying for the roads? So they got to figure things out. They'll probably just come up with some odometer thing and, have some little spy type device in your car, which is obviously we know that technology's out there. Corporations pay tax on their profits. Corporations are like entities. They're like they have personhood on a legal sense, which is kind of if you're looking at business formation, that's one of the drawbacks to being a corporation is that it's double taxation. A corporation makes some money, the corporation gets taxed. The corporation gives money to the shareholders gets taxed. And so it's kind of repetitive. But anyway, property taxes, we know about that and what they're used to pay for. Government services, programs, foreign wars, or whatever. A lot of different things. Some good, some bad. Most individuals pay taxes at the different levels, except in Alaska, for the most part, not a lot of state tax going on here. So the IRS. Yep. Most of us are used to, seeing the taxes taken out of our withholding. Now, again, what happens in the tax system is your withholding is estimated amount, right? So somebody who thinks, oh, wow, I'm doing great, I got a huge refund this year. No, you're kind of an idiot. You overpaid your taxes is what you did. You paid more than... What happens is when you file your taxes in April, because the tax year ends in the end of the year, so December 31st, you pay your taxes in April, you calculate up how much tax you actually are required to pay, and then you compare that to the amount that was withheld. If the amount that was withheld is thousands and thousands higher, you just gave the government a free loan. Now, the government, they're not going to complain about that. But, oh, by the way, if you have to pay a huge tax amount, you got to pay thousands. Now, they don't like that, obviously. They want you to pay penalties. They may want you to do quarterly filings. They don't like getting stiffed, but they have no problem doing it to you. So, anyway, if you do end up with your amount withheld, I mean, sometimes there's unusual circumstances, but for the most part, if you've just got steady salary income, you need to get in there and maybe change your withholdings, do something with maybe you change the number of dependents you're claiming or whatever to get it back in line. You can go talk to the HR people and get that back in line. Social Security and Medicare. So again, supposed to be separate little pots for money to go away with your name on it. Not so much. Social Security, goes for, supposed to be for the elderly, but it also covers sometimes some disabilities and minor children of those who are working. But they keep track. They have, the little quarters there. But the problem with Social Security is who knows what it's going to be like by the time most of you get to retirement age. I think it's supposed to go bankrupt somewhere 20, 30, 35, something like that. So there'll be some changes. Right now, I mean, they're even talking about means testing it, meaning if you've got money from other sources, you may not be eligible for Social Security. Even though you paid in there with your money into a fund and the government's supposed to be, theoretically holding it for you, now they're saying, yeah, you're well off enough, we're not giving it back. So it's kind of a foul from the way the system was started, but that's the problem your generation is going to have to sort out. Medicare, so we got Medicare and then we've got Medicaid, right? Medicare is for people that are 65 and older. Medicaid is a welfare program, but both to take care of people that are older. So Social Security, you can actually max it out. These numbers getting older, but if you're making, say, a couple $100,000 a year, you're not having to pay 6.2 on all of that. You just pay up to a certain level, and your employer matches the amount. So there's a lot of these things too. When they say, "Oh, people should be paid $20 an hour," keep in mind that the employer is probably paying $30 an hour for you, because they've got to do these withholdings and pay these other taxes on you and do other costs. So obviously wages haven't kept up, especially in relation to, what CEOs and stuff were. My old roommate in college, he did quite well. He was super friggin' smart. Anyway, he flew in the Air Force with me and stuff like that, but he got out. He was like super genius kind of smart. Got on with Raytheon, and he retired just last year as the president of the Missiles and Space, whatever area. And he was getting $5.3 million a year. So obviously, there is some difference in income levels between those at the top and those, working out on the line, putting the napalm on the missiles or doing whatever. So there's some issues that structurally need to be kind of sorted out. That disparity between the CEO pay and the other one. But don't get me wrong, I'm not some communist socialist. I'm just saying that whatever, the things need to be figured out. And with the advent of AI, it is going to be tough to get wages up too. So there's pressure on all sides. Self-employed people, yep, you got to pay those taxes. So you don't get away from any of that. And keep in mind, the tax code is vicious. I mean, there is no innocent until proven guilty. With the IRS, you are guilty. Prove otherwise. And a lot of these penalties and stuff are very stiff, because the inception of the creation of these laws around the tax code, a lot of times it's because you get, say, some drug dealer, and you don't want the guy dealing drugs. Well, trying to catch the big kingpin, drug dealer in the middle of a drug transaction, it's not like TV. They don't really want to walk in there and catch the guy, handing the briefcases back and forth. In fact, the smart guy's not going to do that. But what the IRS does, what the FBI and all their friends do, is they walk into somebody's place and they say, "Wow, you got $2 billion or $2 million, whatever, a big stack of bills here. What's the source of this income?" And you're dead in the water. You're like, they're like, "Yeah, show us a W-2 or a bank statement or something where this income is legitimate and not from a bunch of..." So they don't need to find the drugs. They don't need to find the guns. They don't need to get their hands dirty. All they need to do is go, "You got a bunch of cash. Show us where the taxes were paid on this." And the way the codes are written, you can't just say that's my business. No, that doesn't fly. You go to jail. So anyway, different forms, depending on how complex your tax situation is. And again, it's April 15th, unless there's something freaky like COVID or something like that going on. You can get extensions, but if you owe them money and you get an extension, then they want interest on that extension. Kind of a fuzzy chart here, but this kind of shows the total tax cake. So, obviously, a lot of talk about tariffs, trying to get these numbers down. But yeah, this income tax and the payroll tax and corporate tax and then other tax. You can see that, most of it's paid by the people, out there earning money. So if you are fortunate enough in life to get wealthy and you're just living off the interest of or the dividends of your investment, your tax rate is quite low. So it is kind of a foul. They're very concerned about your wage income, but your investment income, and again, you can argue that, hey, that money was already taxed once because it was earned at some point. Although the, trust fund babies, not so much. They started out with a big stack of cash and they just live off the interest and dividends, and the most they'll have to pay in terms of taxes is 15%. So there's some inequities there. What we have in the United States is called a progressive tax code. So if you aren't making much money, you don't have to pay very much, right? And what this chart is showing is the proportion of people. So if this is like a lot of W-2 income. So let's say you're a big, whatever, somebody who's making quite a bit of money. You're a doctor or whatever, and you're in the top 20% of the income. That group, even though it's a very small, it's only 20%, it's paying 88% of the total tax load, just because their income is quite high, but also because of the tax code. The tax code, if you're not, knocking it out of the park, you're actually getting money back. You're taking more money out. Since it's progressive. If you're not making much at all, say less than $10,000 a year, you're not paying taxes. You're taking taxes directly. And this is, in addition to whatever you're able to scrape through in welfare and the rest of that. But anyway, so the very wealthy earners, not the it'd be a little different picture if you went with total wealth of individuals, but the people who are generating W-2 type income, they're paying 88%. Minimum wage, yeah. If minimum wage is where it was supposed to be or should be, it should be, super high compared to other things. So I'm just saying minimum wage was meant to be an entry-level wage, a training wage. You're hiring somebody without much in the way of skills, and you're paying them less. It's not meant to be it's not meant to be a parking place where you're going to go work at minimum wage for your entire life. The way the system theoretically is set up is that you start at minimum wage, get some skills, learn how to show up to work on time, learn how to be responsible a bit, and then your income's going to go up. Although the way it works is sometimes people get in at minimum wage or the store's minimum or wherever they're working, and they're stuck there. So, but like I say, the middle class used to be much more affluent, much wealthier in relative terms back in the day. Not so much. So filing status. Again, getting with this whole progressive tax system. A regressive tax system would be to punish the poor. Like let's say our favorite people out there on the highway, the Anchorage, whatever. If you live in the valley, there's a lot of tickets written, right? And is that a source of wealth for the Anchorage borough? Obviously. I mean, you on an average driving from the valley, you probably see 5 cars pulled over, with tickets. So anyway, there's quite a bit of revenue being generated. But that source of revenue, and I would, from a libertarian's perspective, I would consider that a tax. Anyway, that is a very regressive tax. If I'm whatever dude driving my, brand new Beamer or Mercedes, and I'm, $1 million whatever, and you write me a $100 ticket or a $200 ticket, yeah, that's pocket change. If I'm the poor schlub trying to make it, driving my Beater with a heater to get to Walmart on time, and I get hit with a $100 ticket, it's going to ruin my day. So even though the amount is the same, it has a severely, disparate income on the people getting that ticket. So that is very regressive. Progressive means that, you know, the cop would come up there and say, okay, you got a ticket, you were doing 10 over. Oh, by the way, how much do you make? It's like, wait a minute, what's going on here? Oh, you make, $200,000 a year. Yeah, your ticket's $500. And the other guy, I'm just making minimum wage. Oh, okay, $20 to you. That would be progressive, but obviously a little more complex, and the logistics, mechanics of that would be unenforceable. But anyway, that's how those taxes work. And don't fool yourself that when we talk about total taxes, I think most people appropriately should be fairly big picture that everything from vehicle registration to little tips or taxes on alcohol and the rest of that, that's all tax. And so it goes up. Okay, so filing status here, you enter into the program when you're filing your taxes. You tell them you're single, married jointly, filing separately, head of household. So there can be certain occasions where, and it depends on the tax code, so it's not an absolute. And sometimes you might want to test it out both ways and figure out which way you're going to file to see which way you owe the least amount of money. If you're filing jointly, then you and your spouse put your incomes together and you file it together. But there may be certain occasions where, the one person qualifies for a program, but the income needs to be below a certain level, and if we're together, it's going to be above that level, or you make a whole bunch and your spouse makes very little, and the fact that the spouse makes very little will be eligible for all these programs if they file, separately. So anyway, they don't care how you do it. They give you the option, whatever's most beneficial to you. But typically, single is the worst category. So, because single is going to be, you've got no dependents. We're going to tax you to the highest extent because you have nobody dependent upon you. Now, there are people that end up, and a lot of people who end up, single with children, which puts you in head of household. You're the head of the household. Now, only one of you, the couple split up. The reason why they're also single with children. Well, I'm single with children. So am I. No. Only one gets to claim the dependent. And so, any of you who've been in a divorce, you know how that works. And then a qualifying widower with dependent children. So, let's say you've got you had some bad luck there, and spouse dies. They don't want to, throw you into a higher tax bracket because your spouse died on, January, whatever, not January, but December 20th or something, and, ruin your Christmas, and now all of a sudden you're in a different tax bracket. They throw you a bone there for a little while. Here's the 1040. Now, all these forms, this is where Intuit and these other people make their money. You look at this form and it's like, this makes no sense, and there's all these different things, and very little in the way of explanation, and I just need somebody else to do this for me. And that's where these companies are there to help. And, they're helping for a fee. The good news is, though, that you can kind of, get even with them to a certain extent. For example, my taxes get a little more complex, and because of some things, I've run it pretty close with the IRS in years past, and I always like to have mine done with a CPA. That way they don't, look twice at mine when they see a CPA's done the taxes. They're going, okay, this isn't some schlub. It's sad we have to go there, but that's what I do. But anyway, before I give it to the CPA, because obviously this guy charges by the hour, I run it through TurboTax. And if I want to know, hey, if I do this or that, make this investment, that investment, how's it going to affect things? I could ask that question, and the CPA could take time out of his day and charge me some money and give me a ballpark answer. Or I can just go onto the Quicken site and punch in, bogus numbers or numbers that are forecasted and see how it plays out. So I'll show you that here in a second. The way those TurboTax things go is they do not, you don't pay for that until you actually file. So you can do all this modeling and all this figuring out and different options and just never file with them. You know, you have to file, obviously, but anyway. Gross income, that's money from everything. Wages, salary, interest, you know, other stuff. You know, there's a 1099-G. 1099s are a big deal anymore. Because, again, the government feels like it's their money and they're getting ripped off. So they want to keep track of everything through a 1099, which is an income form. A 1099-G, for example, is a 1099 for gambling. So if you ever go to the casino and you're lucky enough to win, I guess we've actually got a casino now. Anyway, I got to check it out. But if you win some money and it's a substantial amount, they're going to come out there with your money and also with a tax form. Because the IRS will be notified and you will be paying taxes on that just as its income. So dividends, capital gains. So we'll talk more about dividends and capital gains. This has to do with stocks, typically, or it could be capital gains from a home on certain times. So again, the same repetitive definition. Short term, less than 12. Long term, more than 12. Yep. So just say 15% is pretty much what it is. Long-term capital gain or short-term capital gain is at your regular tax rate, which we'll talk about when we talk about tax brackets. So gross income, you know, it's the gross. It's everything. You get a bunch of forms in the mail. The good news is that there's a duplicate set if you ever need them, and that's sent to the IRS. There actually is a way to go to the IRS site and see what they're holding on you, because they've got all these documents. So if you miss one, you go, oh, no big deal. I'll just file without it. The IRS isn't quite as sloppy with their documents. They get them electronically under your social. You know, they don't come in one by one through the mail. They come in as a batch. So their records are usually better than yours. Capital gains and losses. And I'm not going to, teach you how to do your taxes, but I'm going to try to give you some tips or show you how you can at least use TurboTax for a positive thing rather than the, negative force it is. AGI is what happens after you adjust your gross income for things that are deductible. So contributions to IRA, so that's things going to your retirements. Alimony payments, which don't really happen anymore. If there's any children involved, judges will pretty much always go with whatever. They'll finagle the child, whatever they call it, child support, because child support's tax-free to the mother. Alimony, she would get taxed or he would get taxed if they're fortunate enough for that. Interest on student loans, yep, and other special circumstances. So you do a bunch of math here and you come up with all these deductions, the business expenses or living expenses or other things. And you get this number and say you total up all these things and it's like $14,000 worth of stuff. The government says, yeah, you can do all that, or you can just take the standard deduction. And the standard deduction is different every year, but let's say the standard deduction is like $18,000. And so my deductions, I added everything up, and I had to itemize and do all this extra work, and it only came up to $14,000. If I just go with the standard deduction, it's kind of like this one of these fudge factors they pull out of these charts. Anyway, say it's $18,000 in this case. I'm better off taking the standard deduction. So, affected by filing status and age, and then they adjust it each year. So these numbers are old, 10 years now. So that's what I'm saying, like $18,000 or so. To have the actual numbers in here, to know what the numbers are going to be for this next year, you can't file your taxes yet. The people don't the employers and all the investment companies, they don't have a responsibility to get your tax documents out to you yet, so you can't file it yet. So the numbers are still in flux. Now, obviously, if the Harris Waltz ticket would have won, those numbers would have been quite different. Right now, we're still living under the Trump tax cuts from years ago, and so they are still in effect. So those numbers will probably change or go down a little bit. Itemized deduction. So this is what I was talking about. You had that standard deduction. You can do the itemized deductions. So you can deduct all sorts of things. If you interest paid on borrow money to invest, like on your home or whatever. State income taxes, very controversial here. They call that SALT, state and local taxes. And the previous Trump administration had made state and local taxes non-deductible. Then the Biden administration made them deductible. What's this? It's a blue state versus red state thing. What happens are blue states typically have very high state taxes. If you're living in California, between your state and federal, and you're kind of a not an average schmo, but you're a fairly wealthy individual, the take between those state and local taxes and the federal tax all combined was about 63% of your income, which is the reason why there's a lot of U-Hauls leaving California. Now, what the states did, the blue states did, in order to reduce that, they said they worked with the federal government to make those state taxes deductible from your federal taxes. Meaning, let's say you live in California and you owe the federal government, $25,000 in income tax, but when you're able to deduct SALT, your state and local taxes, let's say the state and local taxes were $12,000. Oh, now you only have to pay the federal government, $12,000 because you already paid the state $12,000. So for some of these Californians, this election was quite crucial to them because without the deduction for state and local taxes, they have to pay the full $25,000 to the federal government, plus their state taxes are non-deductible, so now they're up to $37,000. And since the tax code in California is pretty oppressive, those numbers would obviously be higher than what I'm stating there. Okay, so itemized deductions. Real estate tax, yep, deductible. Medical expenses. The sad thing about this is, the good thing is they're deductible. The sad thing is you have to be very sick. Let's say you're making $100,000 a year. You have to have over $10,000, 10% of unreimbursed medical expenses. That means out of pocket, meaning that, if you had $100,000 in medical bills, but the insurance company covered it, well, then you had none. You had zero excess expenses or zero, qualified expenses. But if you had to pay it out of pocket, let's say you had to pay, $11,000 in medical expenses, and so, I can deduct some of this. Yeah, you get to deduct $1,000. That $1,000 that goes above the $10,000. So, not a great deal. Not a great deal. You are a very ill, no insurance kind of person if you're getting that. Charitable gifts, those are deductible. So, quite good. But again, the IRS is kind of, if you notice the old cars being donated for charity, yeah, that scam is pretty much over. People would donate a car, and then they claim, oh yeah, because nobody wants to mess with selling a used car. So they donate a car and claim, oh, I gave away a $5,000 car. Now what the IRS does is they force these auction places to track the sale through. So let's say you donate your POS, to the auction place, you don't get to donate the amount you say it's worth. You get to donate what it actually brings at auction, which is probably not a whole lot if it's a beater. So good luck with that. Anyway, they one by one they kind of clamp down on things. Other expenses, theft, losses, job expenses. If we were talking about, well, I guess we haven't talked too much about auto insurance yet, but we will. But if you smack a car and you have no insurance and it's just a total loss, yeah, put it on your taxes. Now again, if it's whatever, I did this with a 4Runner one time. It was worth maybe $3,000, and I sold it to a guy for $750. So, I could claim $2,250 because I got $750 back, whatever. But job expenses, if substantial, sometimes these job expenses you have to look at the code, but especially being in the military, I knew guys who said, "Oh, I got to keep my hair cut short." And, so barber expenses, that's tax deductible. And I got to subscribe to these magazines to stay current, and the employer doesn't buy them. And I got to have this extra expense. Now, if the employer is reimbursing you for it, no, that's a crime. You can't charge that. But if it's something, that's helping you in the field and you can justify it, that can be deductible. Anyway. Schedule A, and then TurboTax. So I'm actually going to go to TurboTax. I was signed in here a little bit ago. I just came up with a bogus, my UAA ID, and I don't even know what this thing is. Try a couple different ones. I think we got it. Okay, so this is TurboTax. Again, I haven't given these people a dime. Not interested. Born in 81? Yeah, maybe not. Might be a bit older than that, whatever. I put in, a bogus social. I'm not filing this. No crimes have been committed here. None of this is getting filed. So I just put in numbers just to test things out, see how it works. Now, again, the income numbers, I'm going to put in whatever numbers I want to approximate whatever kind of model I'm trying to run. But the beauty about TurboTax is it sort of calculates things as you go. Now, yeah, they are going to be annoying. No, I don't want any of this. And they're going to be trying to sell you other products and, oh, don't you want personal attention and audit advice and all this other stuff, and I don't want any of that. See, look, they're already trying to upsell me. Nope. Enough. Let's talk about income. And so the thing is, you can import a lot of your income directly from the employer. Then you can download the W-2 so you don't have to deal with a bunch of boxes and stuff. I told them I worked at a place called D just because I was lazy. Yes. Now they're going to try and import the W-2, which obviously there is no company named D. I'm going to tell them I made $100,000. It's 1,000, 10,000, $100,000. Boom. Oh, decimal point. Oh my God. People can earn that exact amount, but anyway, you can waste some time on here. It tells me I can get through here and, I've been on here 18 minutes. It's going to take me 54 minutes. They could import these documents, which is pretty slick. It does work. And again, you're not paying for anything later, but they try and keep up with the technology. I'm going to type it in myself because, no, there is no company. Especially with this, you can tell all these numbers. That's my house, whatever. Work at home. Wages, I already had the $100,000. Federal income tax, yeah, maybe they withheld 15,000. What are they doing? 6%? Yeah, about $6,000. again, these numbers are they're just estimates. These numbers that are they're withholdings, right? They're going to correct everything at the end of the year. Medicare tax, I can't remember. I'll go with $3,000. That sounds fine. Medicare wages and tips. Again, tips aren't going to be taxed this year, which is cool. Social Security wages, the same as that. And Medicare wages, yeah, we'll go with that. And see if I'm just trying to do the minimum possible so we can get through here and look at some items. Yep, $100,000, $3,000, sure. State and local taxes, I'm not doing state. And again, once it figures out you're from Alaska, it would skip right through that. But it is kind of good. I mean, this is a lot more pleasant than digging through these forms and looking at books and trying to figure it all out. These things do have checklists, and they are fairly accurate. At least if you've got room to, when the IRS audits you, go, wait a minute, I was in good faith. I made an attempt to get this done. I tried to comply with your law. Ball money, no, I'm not going to do any of that. See, you made any money on gambling, prizes, lottery. They want part of your PFD, as we all know. No, I didn't do any of that. 1099Ks, other payments. Now they're after crypto. That's a big thing, too. Foreign bank account. I always have foreign bank account, but keep less than $10,000 in it, and you just check the bank. See, like here, I'll say 10,000. No, never have more than 10,000, because you don't want to have to answer that question. Anyway, so there you go. We've got blocks being filled out. The time's going down. But it says, because I pulled out 15,000, it's saying, oh, you're going to get this much back. So it's kind of cool. It's giving me a little update. And now I'm going to go down and just sort of advance myself and look for deductions. It's calling them tax breaks. Now keep in mind that whatever they want to call them, tax breaks or loopholes or whatever, those things are put in there by people intentionally. Nothing in the tax code happens by accident. The real estate lobby and people in general like people owning houses. I mean, it adds stability and they want to, they try to encourage home ownership. So they allow you to deduct your mortgage interest. Credit card interest? Oh no. No, you're pure evil there. But mortgage interest will deduct that. Charitable deductions? See, some things are good. They'll let you deduct that. So we're going to go through here and we're going to look at our items. Sales tax, they'll give you credit for that if there's state and local taxes. No, I don't want to do that. Taxes on plane. I'll take care of that later. Anyway, answer that later. As we know, it's got to be 10,000. Do you have a mortgage credit certificate? Doesn't matter. Investment expenses later. Okay, we're about to pitch out of this. You should be doing this. And we'll talk more about this when we get to this section. But basically, if you want to get your taxes to a lower rate, you can end up keeping more of your money by putting your income into an IRA. A Roth IRA is after taxes. It won't affect the amount of tax you pay. But a conventional or traditional IRA or a 401k is what they call tax deferred. You put that money in the account now and you don't pay taxes on it till you withdraw in retirement. A Roth IRA, you put the money in now, but when you withdraw that money after retiring, you don't have to pay taxes on it at all, since you already paid the taxes way back when. So that's kind of cool. Anyway, no, I didn't make any tax payments. Okay, we're just getting out of this. So now we're going to look at some things. No, I'm not going to go there. There's a bunch of extra requirements in here because they had the Obamacare stuff in there. I'm going to look at this. Okay, mortgage interest and refinancing. So the reason why they're saying I'm getting a refund back is because I've got some deductions, right? So let's say donations to charity. I'm pretty benevolent big spender, magnanimous kind of dude. And so I didn't donate just $100. I gave whatever, $6,500 worth of stuff. Whoops. I'm going to edit that. Items. See, this is where it gets kind of dodgy. Now they know that people skimp on this. So do you want to be audited? If you're going to give $6,500 worth of stuff, you better have some pictures. You better, be able to establish that you did some good here, because they're wise to this game. What they're looking for here is they're looking for a date, that's in the tax year of. This would be 2024, because we always pay taxes in arrears. So how did I screw that one up? Oh, there is no 15 month. Got the whatever. We'll call it February. Fair enough. Or we'll call it January. I don't care. Oh, it wants now it's 50. It's reformatting my numbers as I'm typing. Oh, this is frustrating. They think they're being helpful. Somewhere, some dude who wrote this software thought, oh man, this is perfect. No, it's not. Okay, I'm about to give up here. So, yeah, it can be simple and easy, but anyway, it's in the correct tax year. Household item, oof, very sketchy, $6,500. I better have pictures. I better show that there was some sort of value that could be established, maybe an appraisal. Anyway. There's stuff. Again, that's going to get me audited. $6,500. That's going to highlight it. Method determined value. Appraisal. Oh, that might keep that appraisal. Scan that in and have it with your computer. Purchase price, that's probably $15,000, right? And date acquired, I'll just put various. I'm not doing the dates anymore. That was good. How acquired. Golly. So you can see that this, it's kind of sort of fast, but yes. Okay, can we just do this? I just want to see this number switch. That's all I'm trying to do here. Okay, yeah, that's the same address. Bogus address. One more question. Yep, I didn't do anything with, you can't sell this, I'm going to buy it back. Whatever. Good. Every time they ask a few more questions. Okay. And they even have more requirements. No, because I already appraised it. Okay, we're just not doing that. Okay, so I think what's going on here is I don't think we've hit our... why is that number changing? We're going to review that. That number should have changed and gone down because I was very generous. These are last year's numbers. Let me check the property tax. Oh, I know what's going on. I haven't hit the... I haven't exceeded the threshold for the itemized deduction because I'm doing this kind of in reverse order. I'm entering these small numbers in here. And so, obviously, I'm not up in the $18,000 range. You could deduct... Now I'm deducting taxes. So for a second home, you could do that. Foreign real estate, no, not claiming any of that. I'm just going to go with 9. Okay, now I'm starting to get into this bracket where I'm exceeding that deduction. And now watch this. When I put this 15 grand in here, it's going to do something. So Wells Fargo. You get a 1098. You're not just pulling these numbers out. You look on your 1098 statement. Tells you how much interest you paid. Tells you how much tax you paid. And so those numbers are what you deduct. Come on. Oh, I do not want to do that. No, no. I'm going to do it by myself. But yeah, you could go through there and find your mortgage company. And, I mean, you can even snap it with your phone. It's, they try to make things easy, but you can see, just the dates, the technology. Sometimes things go horribly wrong. You think you're saving a tremendous amount of time, and maybe not. Okay. Uncommon situations. But again, it's finding some of these traps that might happen. So 15,000. It's just auto-populating, if you notice, from the numbers from last year. Yeah, it's about right. 280 grand. Insurance premiums, I'm not paying that. Real estate taxes, do not include it here because I already included that. Okay, continue. Boom! You see what happened there? We just jumped by about 3 grand. So, believe it or not, that's the reason I was trying to show you this entire example. Is because I'm trying to point out for later lessons, number one, why you need to kind of know the tax code and how it affects other decisions. So let's say 5 years from now, you're in an argument with your friend, your significant other, and you're like, I think we ought to continue to rent. The rent's $1,800, let's move you on up. The rent's $2,500, and to buy a home is $2,500 on a mortgage. So it makes no difference in terms of money. No, it makes a huge difference. Number one, I mean, for me, obviously, pets and stuff, animals, pigs, other stuff, you can't have that at a rental home. So that's right out for me. But let's say a more traditional kind of person. You don't have all those encumbrances, but maybe you have a dog, so it still might force you towards home ownership. But anyway, the deal with that equivalent amount of rent and then equivalent amount of mortgage is that the mortgage, number one, you're building equity. You're actually buying that home, but as we know from paying mortgages, you're paying primarily interest at first. But from day one of paying that mortgage, you are getting a tax benefit because you are able to deduct the interest and the property taxes on that home. Now, when you rent a place, yeah, your landlord, he's paying interest on the note for that property. He's probably got a loan on. He's also paying the property taxes on that, and he's getting a deduction, but no, that's not being passed on to you. The other thing that's even more important, and this is, so I've kind of given you a little bit of a reason why I think it's a better idea to buy, but the bigger one is move this out another 10 years, and let's say inflation is what it is, your rent for that $2,500 place is now whatever $3,200. That mortgage on that home is $2,500, and it's going to stay that way forever for 30 years until the mortgage is done. And oh, by the way, hopefully that house is appreciating and you have a lot of other good things going on. But just in terms of the tax code, I mean, I consider it fair, but it's definitely tilted towards the homeowner, and we saw it's tilted towards the people who are generous as well. Let's go back and I don't want to get things too screwed up here, but let's just say, yeah, you know what? Screw the kids. I'll give them nothing. I delete the whole thing. And so, yep, they get nothing. Oh. Come on. I see this one. I kind of hate TurboTax sometimes. I just want that number up in the corner to validate my decision. So, anyway, the standard deduction was only $14,600. So the numbers changed. It's calculated on my age, the bogus age I put in there, and also my income. And it did not show here, but I could tell you that number, the amount of money I had to pay, went up significantly. And again, you know. Already not a huge fan of TurboTax, but now I'm getting angry. Keep going. No. That's not going to put the number back up there. It's not going to throw me a bone. It just will not cooperate. Huh. Nope. Not happening. Okay, moving on. But anyway, what it would do is it increase the amount of money that I have to pay. And would change around that standard deduction. And the reason why the numbers started changing, they didn't change down here when I was donating to charity alone because I hadn't exceeded that 14.6 or whatever my standard deduction was. Once I exceeded the standard deduction, now the numbers start rolling. And if you have a bunch of deductions, they roll even better. And you can see all these other things are deductible. You know, student loan interest, foreign taxes. You know, you start putting your IRA stuff here. Let's see them all. Home energy credits. You know, we are basically a bunch of rats trying to get free government cheese. And so they make this maze out there, and we kind of waddle through it trying to pick up as many, you know, things as we can, trying to pay the least amount of tax each year. And that's the game. And there you go. Okay, back to the slides. So we saw TurboTax. Go on, set yourself up a bogus account, play with it if you want. But especially if you're going to make some financial decisions, you know, throughout the tax year, you could run that back in October, because once you get to tax time, you say, oh, I want to do it differently. You can do certain things differently. You can choose your filing status, but you can't, you know, sell stock and have any impact. No, selling stock would have impact on the following year. The tax year closed out on the end of the year. It goes by the calendar year. Okay, beat that to death. Exemptions. This is what I was saying in terms of modifying your withholdings if they're too high. Taxable income. So you get the AGI, less the deductions. Bada bang, you go into the chart and it tells you what you owe, calculating. Here's the thing. This was 2024. So 2025 is probably not out just yet. So this is how it works. Now, the tax brackets, I'll explain to you real quick here, but you're probably not going to get it because most people don't understand tax brackets, and they make it sound a lot more complex than it is, and there's so many really ignorant people out there that think they know what tax brackets are, and they completely miss the boat. So what happens is, let's say you're making $100,000, okay? On $100,000, you have $100,000 worth of income, and you can see that $100,000 stops right here. Now, if you're making $100,000, you don't pay 22% tax on that whole $100,000. No. We have brackets. So what happens is they parse your income into little wedges, and let's say you're a single person, right? So of that $100,000, the first $11,600, you only pay 10% on it. You know, very reasonable. But, you know, if you only make $11,600, 10% is still a lot to ask. And truth is, you'll get some benefits back and you'll end up getting a little money back. Okay, if you're doing a little bit better, you know, you're still in the trailer park, but you're at $47,150, that amount, the first tranche only got taxed, the first 10%, that first $10,000 got taxed at that 10%. This next tranche, the dollars from $11,600 up to $47,000, that segment got taxed at 12%. You know, if you made, well, let's continue on up. And so this next one, 22%, that's all the money that is made between $47,150 and $100,525. So somebody goes, oh, I don't want to take that new promotion because that's going to push me into a new tax bracket and it's going to cost me money. They're stupid. They don't understand the tax code. Let's say you're in this scenario and you are making $100,525. So you're right here. Let's say you get a raise, you know. Again, you know, their idea of a raise is kind of like my idea of donations. They give you $10, you know. So you make $100,535. So, I'm in the 24% tax bracket. No, $10. $10 is taxed at 24%. The rest of the 100,525 is taxed at these lower respective amounts. So if you get pushed into a different tax bracket, that's just a stupid way of saying it. You're not pushed. You have income that goes into this other tax bracket. And keep in mind, this is AGI, adjusted gross income, not gross income, the one that's actually, or the taxable income, the one that's reduced. So it's not as bad as it seems. And so the tax bracket right now, I mean, we're kind of in line with what I'm talking about in terms of the Laffer curve. You know, you're making whatever, 609,350. You're paying short of 40%, but it's still a lot, but it's not so much that, you know, greed's going to kick in. You're going to want to still make $1 million. That 37% is not going to be such an impediment to you. You're going to go, screw it. I get that other 63%. I'm good. So again, that's why if this was 90%, people would say, yeah, that's the day I quit work. Once I make $609,350, any extra income, if it's going to get taxed at 90%, I ain't doing it. Or I'm going to hide the money, or I'm going to move, or I'm going to do whatever. But in any case, any scenario, there is no scenario where the IRS is going to end up with it, because it just ain't going to happen. Nobody wants to pay that. So, long-term capital gains rates. So when I said it's 15%, it's 15% for most of us. You know, if you're, again, you know, in the trailer park, God bless you. You get it free. No tax, because you had it for that long. This is long terms. And then if you're the middle range, which most of us are, 15%. And even if you're knocking it out of the park, you know, damn near $500,000 a year, you're only going to have to pay 5% more. So that's why when I say 15%, I can kind of say that, because that's where most of us are. Determine your tax liability. Yeah. Again, it's going to end up going into a table. The thing with TurboTax and things like that, they've got the tables in there. Tax credits. So, big difference here between a tax deduction and a tax credit. They're not at all the same. Again, misconception. You know, you need to talk to somebody when you're asking them to do taxes or something. Just, you know, have a good understanding of these terms, and then don't challenge them too much, but kind of probe them a little bit to see if they know the difference between these things. A tax credit is a freebie. You know, tax credits are for doing good things. You know, if you adopt a child, you know, man, you're keeping a kid out of an orphanage. You're helping somebody out here tremendously. This is huge. You're a great person. You know what? We're giving you a tax credit. That means if you owe $10,000 in taxes and we give you a $1,000 tax credit, that means you reduce your taxes by 10 or by $1,000. You get the whole thing. It's a credit. Just subtract it from what you owed. Now, what people don't understand is tax deductible. Tax deductible is a whole different thing, because that means that you're able to reduce your income that's reduced on that. So, you know, let's say you owed $15,000 in taxes, you know, you're able with a credit to only pay $14,000 in taxes. If you get a tax deduction, it just means $1,000 tax deduction means that you're able to reduce your income by that amount. So let's say you made $100,000 and you did something that's tax deductible for $1,000, you're able to reduce your income down to $99,000. But that in no way takes off $1,000 off your taxes owed. You know, say you're in a 30% tax bracket, you would get the equivalent of $300 of benefit for that $1,000 deduction. Anyway, it's not that complex. I may have just kind of tumbled you a little bit, but you can look at the homework and see an example. Okay, college tax credits. These things have limits on them. I've gotten to a place where I made enough money where, oh yeah, there's a full tax credit. Oh, except for you because you made over whatever dollar figure. 529, good deal here. This is, let's say you're doing your term paper and you want to get an A, but you say I'm going to set up a fund for the child's college and I'm going to put it in a mutual fund and that's it. You'll get a B because you did use one of the tax incentivized type things. You put in a 529. If all that money is used for college, that child doesn't have to pay taxes on it when it's withdrawn. So, you leave your child $100,000 in a conventional fund for college, that child gets, what, 85,000 of it? You leave that child $100,000 in a 529 plan, and he gets all of it. Or if they, choose a different path in life and don't go to college, then you get the money back and maybe you pay a penalty, but you're not in much worse shape. It's a good idea. They incentivize that. Earned income, that's where people get money back who don't pay. Fair enough. More Intuit stuff. This isn't an Intuit ad. I do not like that company. I do not like their business practices. I don't even like their software, but they're kind of like Google. I mean, they're there. You can be this purist and try and ignore them and make your life a little bit more difficult, or you can just grudgingly take advantage of it where you can. And then homework. Sweet. Okay. So the deal with the homework is, yes, you put it together in a bulk assignment. You hand it in prior to the midterm. So I'll put together a thing on the homework to kind of help people out, to kind of refine where to find the questions, and I'll put that out this week. So anyway, till then, see how long we went. Felt like it was forever. Yikes. All right, till next week.